Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. I don't know if this is anything that I've ever done personally or if you have, but we're live on YouTube, we're live on LinkedIn, and we're live on Zoom, of course.
Nice. That's awesome. Okay. I have not done that. I didn't even know we were doing that. So that's good to know.
Exactly. So I know we've got literally hundreds of people watching us right now across 3 different platforms. So no pressure.
Yeah, no problem. And first of all, I just want to say thanks for finally getting me on your podcast, Jeremy. It's been like 2 years, and I know that you rebranded it to be with our company branding. So it's about damn time. So thanks for getting me on. I appreciate it.
Yeah, no, I appreciate it. And it's funny you say that because I was actually thinking to myself the last time that I had you on the Rise podcast, which was formerly known as the Freedom Point podcast. You were a guest, I think, number 100, and we've now gone well past 250 episodes at this point. So it's about time we get you back on again.
Yeah, no, it's been a while. It's been a while. Well, yeah, happy to be here. Thanks for having me, Jeremy, and looking forward to it.
Yeah, absolutely. Likewise. And for those that aren't familiar, welcome to the On the Rise podcast. I'm your host, Jeremy Dyer. Really appreciate you being with us here again today on a podcast that's live, first ever in history, for the podcast. So really looking forward to having my guest on, Zach Haptonstall again, who is the CEO and co-founder of Rise48 Equity, also a close friend of mine. Really looking forward to kind of, really looking in the rear view mirror a little bit today, on the podcast, plus some forward-looking commentary and discussion, but just the state of the market. So before we get started here, I'd like everybody to feel comfortable, give us a like on whatever platform you're on, give us a heart, give us an emoji, throw us a hey you kind of a thing. We'd love to hear from you. Feel free to ask any questions that you have. We have multiple people watching the live stream right now that are able to answer any investor questions that you have. So we'd definitely like to engage with you as well. So before we kind of, really get into the heart and the details, Zach, maybe if you can give our listening audience a little bit more information about, who Zach Haptonstall is, your background, your journey, what you've been focused on today, et cetera.
Yeah, absolutely. So I'm Zach Haptonstall, CEO and co-founder of Rise48. I was born and raised here in Phoenix, Arizona. So I just grew up in a lower middle class family, no real estate background, no family money. My dad worked in construction doing like exterior painting, for projects. And my mom was like in HR for like an accounting firm. And I just remember my dad always saying how he hated his job. And he always told me like, hey, work hard, get educated, get a degree so you don't have to do what I have to do, which is work outside in the heat in Phoenix year round, which sucks. And so that really stuck with me. I was always like a very good student, always wanted to work hard, get good grades. I was naturally very introverted and insecure. I was kind of like a chubby kid, you know what I mean? And kind of I don't want to say bullied, but kind of had a chip on my shoulder. I go into high school and I started playing football, and I was a good football player. And I was an offensive lineman, believe it or not, offensive tackle. And that kind of really helped, forge my mindset and kind of get like this warrior mindset, warrior ethos, which I think I would carry even to this day, which I think was really important. I was an undersized offensive lineman. So I was, first team all state, won a bunch of awards, but I was a 220-pound offensive tackle my senior year. And all the 4 other all state offensive linemen were like 280, 300. They go to D1. I had to go to Division II school, played college football for a couple years and realized I wasn't going to go to the NFL, wasn't big enough or good enough. So my next best thing, Jeremy, is I really liked sports. I wanted to become a sports reporter. So I got a journalism degree. And again, remember, I was very introverted by nature, but I was like, I really want to do this. I want to be a live news anchor. So I went to like the top journalism school in the country, which was the Cronkite Journalism School here at Arizona State University. I got into that school. I auditioned to be on the newscast, which basically is on PBS, and I got that. And it's funny, like I went to school with 2 of the top journalists in the country right now. Like there's a guy right now named Bill Malugin, who I see him on Fox News all the time now. He's like the top congressional. I went to class with that guy. Him and I were like the main anchors for the PBS newscast. And then there's a guy on MSNBC right now who's like their top congressional correspondent. So we got both wings of the party covered with my classmates. But long story short, I did the live news anchoring, sports reporting, hosted a show on Fox Sports Network, and it was cool at first, but I realized like, hey, this sucks. This is not what I want to do. Like, it's not as fun as I thought. It's not like being a sports fan. You can't make a lot of money doing it. And again, like growing up, money was always just a very big challenge for my family. I remember my parents got, really wiped out in the '08 recession, '09, and so it was always you have to be very frugal. I mean, to give you context, like the high school I went to, I was like a minority white guy at my high school. It was primarily Hispanic, and it wasn't the greatest part of town from like a socioeconomic way. We had a bunch of stabbings and gang wars at my high school all the time. They took away our class colors my sophomore year for the rest of my years because of gangs, and how they might, represent the colors of the gang. So that's just gives you context and like the environment, which I think was really good because it gave me adversity, it gave me perspective, diversity on, the world. And so I was really focused on like I want to be financially independent. I don't want to have to struggle and have that, for my kids. And so I remember when I was 18, I read the Dave Ramsey book and I learned about, killing debt and just being very frugal, things like that. So long story short, I graduate, I'm 21. I have a bunch of student debt. Okay, I didn't get a single penny from anybody for school. I was working full-time nights and weekends, 40 hours a week while I was going through school. Even while I was playing college football, I had to work. I worked at Home Depot 30 hours a week and then, later would work 40 hours a week delivering medical equipment. I had to take out student loans. By the time I graduated, I still had student debt. I had a crappy truck that would always break down and I needed to buy a new car. I needed to make money. And so I was like, I don't want to do journalism. How can I make money? And when I was going to school, I was delivering medical equipment, like an odd job I had through like a girlfriend's dad at the time. I was delivering medical equipment nights and weekends. And he was like, hey, you can make good money in healthcare marketing. So I was like, okay, I'm going to do that. I want to follow the Dave Ramsey plan. I want to kill my student debt. I want to buy a new car. And so I went, got a job as a hospice marketer. Okay. Hospice, for those of you who aren't familiar, and this sounds weird, but basically, hospice is like end of life care. It's like mobile nursing and caregiving for people who have terminal illnesses. They could be on hospice for a day or a year, whatever. My job was to wake up in the morning and drive all around Phoenix, cold call, literally walk into hospitals, doctors' offices, assisted livings, skilled nursing facilities, and just literally walk in cold to these people who are doing their jobs and bother them, like social workers, physicians, nurses, and try to get referrals. And then when I get a referral, I meet with them and try to sign them up on hospice. And so it was tough. It's kind of like selling Cutco. You're just like a door-to-door salesman and you're bothering people who don't want you. But it was really good because you get your teeth kicked in every day. You face a lot of rejection. And in hindsight, I'm grateful for that. So, anyways, it sounds weird, Jeremy, but hospice is a very lucrative and competitive private business industry, all regulated by Medicare. And Phoenix is like the number one market in the country. It's Phoenix and Florida, which you can assume, all the geriatric retirees come to these markets. And so I started out making $35,000 a year. Within a matter of months, I got promoted to $55,000 a year. I then jumped to a different company making $72,000 a year in less than a year. By the time I'm 23, I'm the director of marketing. I'm managing a team of marketers. I'm making $150,000 a year, and I buy a house. I bought my first house when I was 23. So at this point, I'm making more money than both my parents combined have ever made. I have a house, and I go start to get my business degree. I was like, I want to get an MBA, so I did that at night. I went to night school at Grand Canyon University, and I was working all day and then doing my MBA nights and weekends. And so, by the time I'm 24, I graduated, got my MBA, and I had killed all my debt. So I have a house. I paid off my undergrad degree. I paid off my master's degree with cash. I bought a new car, paid it off because I was like extreme Dave Ramsey. Like I was not spending money on anything that wasn't absolutely necessary, being very frugal. By the time I'm 26, I'm making over 200K a year. I have no debt. I have a lot of savings, and I was completely miserable. I was like, what's the point? I was like, I've paid off my debt. That was the reason I got this job. I don't even care about hospice marketing. I did it as supposed to be a short-term thing. And I honestly felt unfulfilled because I was so focused on having a goal, staying disciplined, and I didn't have a goal that I needed to achieve. I mean, there's hundreds of marketers in this market, and in all humility, I was probably the top guy. I was just dominating the space every single month. I mean, you can appreciate that, Jeremy, as a dominant sales guy at ADP, as you were for decades. But I was like, what's the point of this, you know? And so I was like, I need to somehow make money passively. Like I want to make passive income because I have the first of each month as a sales guy, you clear the board and the pressure is back on, right? And you got to perform again, and it's very transactional. And so I didn't know anybody in real estate. I had gotten my real estate license a couple years earlier, just after the MBA, because I had nothing else to do. Never used it. Started reading books, listening to podcasts. Read Rich Dad Poor Dad. So that was in December 2017. I was like miserable. I was like, I don't know what I want to do, but I'm not going to be able to figure it out with this job. So the next month, January of 18, I quit my job and I had a little bit of sweat equity in that company that I cashed out. And so with my relentless savings the previous 5 years and cashing out that equity, I had about 300K of cash. And I thought I was like rich. I thought I was like balling. You know what I mean? Like, oh, I got
Yeah.
300K cash.
Right.
Like, holy shit, this is a lot of money. And my plan was live off the savings and figure out how to make money in real estate. Okay, I don't know a single person, and I'm not trying to say that to like sound arrogant. I didn't have any mentors or anything, no family money, nothing. My parents thought I was crazy to leave a good paying job like that. At first, I was looking at flipping houses, so that's all I knew. And I created a little LLC. I opened a bank account. I got a credit card, and I was like, man, this is very transactional. This is not what I want to do. So long story short, read a bunch of podcasts, books, et cetera, learned about the concept of syndication, leveraging my time and energy and leveraging other people's money to create a win-win situation so that I could scale a business. Looked at mobile home parks, self-storage, ultimately decided on multifamily. Lived off, I don't know how deep we want to go into this segment, but lived off of savings, didn't buy the first deal for 14 months, made no money the first 3 years. So 2018, 2019, 2020, we bought about six deals, 60 million. I was dead broke. I was paying minimum credit card payments on my credit card, so I didn't go into default. My now wife, who was then my girlfriend, was covering our bills. So she was working and basically covering our bills. And I did pay her back later. I paid off her car later to get her back. But I made no money for literally 3 years. Was like literally just trying to stay above water, dead broke, had to get part-time jobs, go back and get a job, all this stuff. We started selling our first deals at the end of 2020, got a lot of liquidity, and quit the job again the second time for good and reinvest that into the company. And then 2020 we kept growing. So that's kind of how the first few years went. I know it was kind of long-winded, but that's kind of how we got started.
Yeah, no, I appreciate that. And that's great, great perspective, especially for those that aren't, familiar with you personally. A lot of our regular listeners of this podcast, have kind of heard my story, multiple times. So I think it's important for people to kind of see, your background and kind of your journey of where you got to where you are today. So let's maybe dive into Rise 48, specifically, why is it or how has the company grown so quickly in such really a short period of time? I mean, I can't think of any other operators, in the space that have grown as quickly as Rise 48 has in just the last, 7 years.
Yeah, I mean, it's a good question. I mean, it honestly feels like it's been 15 to 20 years. We feel like we've been through hell and back the last few years with interest rates and all the adversity. Um, I think it comes down to, one thing I realized when I was first getting started is that I was trying to figure out what I wanted to do. And I you get all these people tell you you can't do this, you can't do that, this is a stupid decision, and you start to really build a hardened shell. And I was looking at all these different asset classes, and I would look at mobile home parks because people say that's a cash cow. And then I look into it and I say these cap rates are compressed, this is saturated. I get discouraged. Oh, I missed the boat. Right. Then I look at self-storage. Oh, self-storage. Oh, it's competitive. Man, I missed the boat. And I finally realized, Jeremy, that I was getting that shiny object syndrome, right? Where I'm trying to do all these different things and jumping from thing to thing. And if something is successful or there's people that are successful in a certain space, that's because it's probably a good idea. And I had to shift my mindset to think, okay, I don't need to worry about competing with the market or them. They have to compete with me. I have to stay laser focused and just go very deep, not wide. Okay. So when people say, hey, how did you grow so fast? It doesn't feel like we have grown fast to me. In fact, I was just telling my partner Bikram yesterday. I was like, I feel frustrated. I feel frustrated that we are not growing. And it's just it pisses me off, honestly. Like we just feel like we're stuck right now, stagnant. We're not growing as fast as we want to. And I think that it's just having those daily disciplines and staying laser focused and doing it one deal at a time. I mean, trust me, when 36 months go by and you are dead broke and you have nothing to show for your effort, you don't feel like you're growing quickly, right? And so in 2021, we're able to start selling deals and everything started to click. Okay. And so before we're broke, so you don't have liquidity to hire staff. You don't have a reputation to really source a lot of deals or raise capital. And because you don't have liquidity to build out infrastructure, it's hard to operate these things. You're using third parties. Well, that's when everything really started to turn around, is that when we started selling those first few deals, I mean, we're making millions each, Bikram, Robert, and I. And we could have just sat on that and kept it, a lean little company and lifestyle company. We took all our profits literally and reinvested it into infrastructure because our goal is to be one of the biggest, if not the biggest real estate company of all time. Like we want to be a dominant player for decades to come. Everything we've done is with this long-term vision in mind. We're not trying to just make a few million and then go sit on a beach. Okay. I personally hate vacations. So you can ask my wife. I cannot go on a vacation because that's just not fulfilling. And so everything was all about the long-term mindset, and it continues to be that way. And so when we start selling deals, you are getting flush with liquidity, which you can reinvest into the company to create infrastructure and hire out staff. It was Bikram, Robert, myself, and then Bikram's wife and my wife the first 3, 4 years. So we had 5 full-time free employees, and we did every single department you can ever imagine. Okay, acquisitions, transactions, underwriting, asset management, investor relations, accounting, et cetera. So what that allowed us to do is now that we had liquidity, we could hire staff. So we were basically recruiting, hiring, and training to replace these roles that we were having to do so that we can focus on higher level ways to grow the company, to optimize operations, things like that. Also, when you're going full cycle, you're selling deals, you're getting, happy investors, and investors are referring you more investors. When you're closing deals, the brokers, I mean, most people in the space know there's like 4 or 5 brokers in every major market that control 90% of the inventory. And it's not a fair game at all. Okay. And so when you are able to prove yourself, we're now getting off-market deal flow, that nobody else is seeing. So now we can raise more money, we can source the better deals. We're taking our profits, investing in infrastructure. So in 2021, we started our own property management company, Rise48 Communities, and we started our own construction company, Rise48 Construction. Previously, we were using third-party companies, and we weren't happy with the results. They weren't staying on schedule or on budget for operations, renovations, et cetera. So we said, if we're going to hit the goals that we want to achieve, we need to have full control and be vertically integrated. And so that's when everything really started humming. And so 21, we buy 16 deals, 560 million. 22, we buy another 16 deals, 800 and something million. So we bought in the first 3 years, we bought 6 deals, 60 million. In the next 24 months, we bought 32 deals, 1.3 billion. Okay. So there's like that analogy of like the rocket ship where it's going to use all this fuel and energy to get off the ground. But when it gets to a certain altitude, it's just going to kind of, coast or whatever. And we started to see that growth. Now, I tell people the first few years, we make no money. We make a lot of money 21, 22, and then interest rates skyrocket. And so the last few years, 23, 24, 25, this year, we've been playing offense and defense because we bought a bunch of deals at the end of 21 and early 22 with floating rate debt, and the whole market got impacted by that. And our whole philosophy has been the last several years, we're going to fight to the death to continue to grow and to protect all of our investor capital. And so we've never missed any debt payments on any loan ever in the history of our company, never been in default on any property, never lost investor capital. And that warrior mindset has allowed us to grow and continue to grow because what's happened is, there's been a lot of distress after that 2022 interest rate escalation. And so a lot of these groups cannot raise money because they're getting foreclosed on, they're selling for a loss. We've been able to really just get through the storm and restructure those deals and those loans. But then we've also been playing offense. And so end of 22, we realized, because up to this point, Jeremy, from 2018 through 22, we were only in Phoenix. Okay. This is where we live. Our corporate office is here in Scottsdale. We were only in Phoenix, and investors were like, hey, we like what you're doing. We want more diversification. And so we said, you know what? now's the time to expand to a new market where there's a lot of the competition is on the sidelines because of interest rates and distress. We expanded to Dallas. And so in 23, we opened up an office in Dallas, built out a team there. Then 24, we expanded to North Carolina. And so we were able to really take advantage of the challenging times of the market. And we've kind of been the grim reaper the last 3 years. We've bought over a dozen deals for literally the loan amount of sellers, wiping out all their equity because of loan maturities, things like that. And so it's been offense and defense. But what we've learned is how to build out a blueprint and scale staffing ratios. I mean, right now in Phoenix, we own 30 assets, 6,000 units. In Dallas, we have 15 assets, 3,500 units. And we've got like 200 employees in Phoenix. We've got 85 employees in Dallas. In North Carolina, we've got 9 assets, 1,500 units, about 40 employees. And we know the formula, okay, for the staffing ratios, for how to find people. We'll fire people very quickly, and we do all the time if they don't perform. And so I think long-winded answer, but staying very simple. Okay, I tell people we are a very boring company. We're very vanilla. We stick to this one box. Okay, we buy these types of deals in these markets, and we do not stray. And we rinse and repeat over and over. And that is what has allowed for some of this exponential growth. So on the outside, people think, oh, you're growing so fast. But internally, like we are grinding every single day, right? Like everybody is here at the office every day. And we are grinding and we push people. We have a high level of accountability. And so I think that if we would have got strayed, and we have strayed in some regards, which I can talk about, like the HVAC company and third-party management, I've made the mistake of straying the last couple of years and I've corrected it. But I think if you can stay laser focused and go really deep, that's how you'll grow instead of trying to all these different things and never really becoming very efficient at any of them.
Yeah, no, I appreciate that perspective, especially as an individual investor. A lot of people that have heard me talk before, know that I try not to invest in the shiny new object because usually by the time we hear about the shiny new object, that's the time to not invest in that particular, asset class or that investment. And, I know there's a lot of operators and competitors in the space, they're not laser focused on a very narrow and boring buy box. They will open up to different, asset classes, different markets. And I kind of think about my own life. I don't consider myself to be a jack of all trades, but when I try to do too many things at once, it can become very stressful. And then it basically makes it very difficult for me to be effective at maybe the one or two things that I ought to be focusing on in the first place, if that makes sense.
100%. And it's human nature, Jeremy, right? So like a quick example I'll give, I don't want to go too deep on this tangent, but quick example is that the last few years, multifamily has been tough. Interest rates, new supply, things like that. So I was thinking a couple of years ago, I was like, we should diversify our revenue streams and start some ancillary companies, right? And so beginning of 2025, what we did, we started our own HVAC company, HVAC air conditioning company, because we own and manage right now over 11,000 units. And the whole thinking was, okay, for every time we need to do a repair or replace an HVAC unit, let's get 3 third-party bids and let's match the cheapest bid. So we're doing our fiduciary duty to the investors, but we've got guys on the team that are HVAC certified that know how to do this, and we can actually get the work done faster and significantly cheaper for the property, and we can make a profit margin. Okay. And so it seemed like a no-brainer. So what I did is I gave 2 of our key employees who oversee our operations equity in this HVAC company because I want them to run it. I trust them. They know all the people. They can build the team, make it happen. In the first 12 months from January through December of 25, we did over 3.5 million in revenue and over a 35%, or just about a 35% net profit margin. So we made over $1 million net profit on a newly created company in the first 12 months. Okay, so you'd say that's a great business, right? And we're doing just our own work. We're not doing any third parties. But throughout the year, I was telling them we hired a marketing guy. We hired all these different staff members. I said, you guys need to build third-party business to make this like a real HVAC company so that it's not just standing alone on the Rise48 portfolio. And what that did is it distracted them. Okay, and I started to see them getting distracted from our core business. In 2024, one of our lenders, they foreclosed on other borrowers, not us, but over 1,000 units in Dallas. And they reached out to us and said, hey, you guys are doing a great job managing the assets that we have with you. We just took back over 1,000 units from these other borrowers. Can you manage these for us third party? And I said, yeah, of course. I mean, that's a fee stream. Why wouldn't I want to do that? And we're going to help out our lender. And I looked at it as a tentacle. We're going to latch on to other properties. We're going to feed HVAC. We're going to feed construction. We're going to make all this extra revenue. But those two businesses started to distract our key people from our core business, which was our portfolio. And so I read a book called The Science of Scaling over Q4 and the Christmas break, which really talks about just staying laser focused on one goal, one business, and nothing else matters. And so it was New Year's Eve. I texted our leadership team, and I don't drink, by the way, but they probably thought I was drunk because it was New Year's Eve. I'm like listening to a book at like 9 o'clock on New Year's Eve. That's what I do to stay up late for the New Year. And I texted them. I said, "Hey, effective tomorrow, we are collapsing the HVAC company and the third-party management company. Lay off all the people." So we laid off 50 people the next day, and we shut down both companies. And they were both profitable. They were both making a bunch of money because it was the principle that was this year, by the way. That was this January 1st, 2026, a few months ago. And none of them replied. The next day, they're like, "What the hell? Like what's going on?" And I said, well, "You guys are getting distracted. We're getting distracted as a company. We need to stay laser focused on growing our core business." And the last few months, we've just been exponentially optimizing internally. Okay. And so I'm giving you an example of how I make the same mistake, and we all make these mistakes. And I've realized sometimes it's going to be boring. And there's a book called Mastery by Robert Greene. You know, it kind of talks about that whole concept of the 10,000 hours you have to spend to achieve mastery. And you have to endure what's called tedium, which is basically you have to endure these boring days where you feel like you're not making that tangible progress because you are making progress. It could be subconscious, you know, things like that. And so we have to just remind ourselves to stay consistent and disciplined and laser focused. And that's because I don't want to be average in a bunch of different things and make money a bunch of things. I want to be elite in one thing. You know what I mean? And so that's kind of the philosophy there.
Yeah, no, it makes total sense. And I know that those, successful salespeople that, is kind of an avatar, group that I came out of, my feedback to them is the same thing, is if you kind of feel like you keep coming up against a wall and you're not making progress, you probably are. And you just need to continue to stay consistent because before you know it over time, you're going to break through those barriers. Just another, just kind of quick update here. I know a lot of people have joined. We have hundreds of people now that are watching, this live podcast live. So just as a reminder for those that are here, please give us a like, give us a thumbs up, enter in a comment, any questions that you have to those towards the end here. But I did want to ask you, Zach, you talked about being vertically integrated on the property management side, construction management side, supply chain, those sorts of factors. As an investor, I'm really looking to reduce three risk factors when I make a decision myself to invest into a deal. One is operational risk. Two is execution risk of the business plan. And then number three is what I call market risk. So how is it that Rise, being a vertically integrated operator—
Oh, did we just lose Jeremy? Are you there, Jeremy?
I'm back in.
Okay.
So
All
sorry
right.
about that, fellas. So
No worries.
how is it that being vertically integrated on property management, construction management, and really the supply chain, how does that help Rise 48 as an operator reduce those three risk factors of operations, execution, and market risks?
Yeah, no, it's a great question. So I'll give you some context and then I'll answer your question. When we got into this business, I was listening to podcasts, reading books, and I thought that I could go out and raise money, buy a deal, slap a third-party management company on the deal, and they're going to do all the work seamlessly, and I'm going to sit back and collect the cash flow. And so we used third-party management, third-party construction the first few years with the company, and it was just a disaster. Okay. I mean, the very first deal that we bought, a 36 unit, $3.5 million deal, they're not staying on schedule or on budget for the renovations. And this is when the market was really good. They're not leasing at the cadence and schedule that we're telling them that they need to lease. And then you go to the third party. And again, I'm not trying to bash all third party property management. I think that you need to have a certain scale before it makes sense to become vertically integrated. But we went through three different companies and we did not get the performance that met our expectations. The biggest challenge is like if I've got a leasing agent or a property manager at a property that I don't think is a good fit or is not doing well, I need to be able to fire that person immediately. But when you're using a third-party management company, you can't fire that person because that's not your employee. You can complain to your regional director or the owner and try to get them switched, but you don't have full control. And so we said, you know what, we need to have full control over all the on-site management as far as staffing so that we can align their incentives and their bonuses to align with the goals of the business plan and that specific property, because not every property has the same business plan or the same monthly goals it needs to hit for collections, delinquency, occupancy, whatever. And then on the construction and supply side, we're getting these bids from these third-party construction management companies or these GCs on what it's going to cost, and then literally within a month or two, they're blowing the budget. And we're like, guys, you just screwed up our entire business plan. Like, this comes in 10, 20% higher on materials and labor. You killed our entire pro forma. And that was frustrating those first few deals. So we said, man, if we're going to keep going, we got to invest in this and have full control. And so on the property management operations side, that's critical because every single employee at every single property, from a leasing agent to a maintenance technician to a property manager to a porter, those are our full-time W-2 employees. Okay. And so we have full control over which properties to put them on. If I need to fire somebody because they're not very good, or maybe they're going to be better for a different property and a different demographic, geographically, and they'll thrive there. Well, I should be able to move them, right? Or maybe I have an employee who's really good at making a turnaround. Like if a property has tanked in occupancy and they can come in and just boost it in 30, 60 days, I want to use them like a chess piece and I want to strategically move them around, which we have a few of those people. And then on the operations side, so what we did, the construction side, is that we started sourcing and purchasing all of our materials directly wholesale from overseas manufacturers. Okay, so we are controlling our supply chain completely. All of our flooring, countertops, appliances, cabinets, everything, blinds. We have full control of our supply chain and we have fixed pricing. We also have fixed pricing on our labor. Okay, so what we do is we have contracts with our suppliers where, let's say we're going to buy a 200 unit apartment building and we are the GC. And so we're controlling all this and we're also getting deep rebates because we're the general contractor. So we're getting discounts there as well. But basically, we're saying, okay, I'm going to pay you, Mr. Supplier, X price per door. I don't care if it's a 1-bedroom or a 2-bedroom or a 3-bedroom unit. I'm paying you X price per door for materials for these 200 units for the lifetime of this project. My pricing is literally fixed. I don't care if in 2 years from now there's tariffs or supply chain issues, my pricing is fixed. We have that agreement on all of our deals. Like literally deals that we bought in 2021, when we need to turn a unit or renovate a unit, we're paying the same pricing that we were paying in 2021. And pricing's gone up significantly since then. And then on the labor side, we are the general contractor, but we use third-party construction companies. Okay. And so we're using third-party companies, subcontractors, and we have agreements with them where we are paying them a flat price per door. Again, it doesn't matter what the unit is, the unit mix, for the lifetime of the project. And it's because we have volume and scale that we can get that leverage, right? And so initially, how this works, just so people know, is that construction companies are making most of their margin on materials. Okay, they are marking you up on their materials, and that's how they're getting their profit margin. Once we took all the supply chain in-house and we started working with the same construction companies, we said, okay, now we're buying on controlling our materials. You are using my materials going forward. And a few of them said, no, we don't want to work with you. We said, okay, fine, we're not going to work with you. Like, screw you. Go pound sand, and they say, wait, we'll make it work because we're giving them so much volume and they know it's going to be consistent volume. And a lot of these guys have followed us across multiple markets. We have vendors who have literally purchased homes in Dallas and in North Carolina, and they'll ship out 10 guys on a big Sprinter van to do work for us. And so it's those programmatic relationships that we can rinse and repeat this construction work. So my all-in price per door for labor and materials is fixed and flat. Like as an example, in 2021, when the Biden administration came in, there were macro supply chain issues in like Q1 and Q2 of 21. And I know a lot of peers in the space that were having trouble getting appliances and stainless steel appliances. We had no issues with that because of our supply chain. We had plenty of materials. Last year, everybody was freaking out about tariffs and all the impacts it would have. We'd had no issues with any of our pricing changes. Pricing on these properties change at all because we had built up a big inventory supply with our suppliers at pricing that was already pre-established. And so having the benefits of volume, economies of scale has really benefited us. And again, that goes back to that methodical cookie cutter approach that we have, that we're only going to buy existing deals that are in these specific markets with these types of rents that we can do this uniform renovation program on. And we've renovated thousands and thousands of units to this exact same scope. And so that's given us a huge advantage to control, all the variances that can happen. And that's why we're for like multifamily operators, we're almost like the last of the Mohicans. You know what I mean? A lot of these guys are just gone. You don't hear about them. They've gone bankrupt. They're head in the sand. But we've been able to consistently grind through the last few years through operational excellence and huge credit to our team and our leadership's team to make that happen. And that's been the biggest differentiator.
Yeah, and you can really reduce, execution risk a lot when you have all these different components, in-house. You really control that timeline from acquisition, of the asset all the way through, disposition. You alluded a little bit earlier about talent management, and would love to hear your kind of feedback as to the culture index
Yeah.
that Rise recently implemented across the organization about a year or so ago, and that how that helps Rise recruit, best in class talent, and really making sure that we have the right employees in the right roles throughout the organization.
Yeah, great question, Jeremy. And so, we've gone through these different life stages of growth as a company. Initially it was just the three founders and our spouses. And then you start hiring people, and it's easy to manage when you have 5 people, 10 people, 20 people. You know all your team members, you know all the employees. Well, when you start to get to 350 full-time W-2 employees, which is what we have right now, spread across the country in 3 different markets, from Arizona to all the way to the East Coast and North Carolina. I don't know everybody's name. I can't personally influence these people. And what we realize is that not only do you need to have your staffing ratios in place, you need to have aligned values from your leadership team to your middle managers down to those frontline team employees. And so, it's like how do we roll that out and really communicate that? And again, I haven't had like a business mentor. There's no blueprint on how to do this. One group I'm a part of is called YPO, Young Presidents Organization. That's been really helpful, just getting resources from other founders and CEOs who I know. And so, yeah, to your point, there's 2 different programs we've implemented the last couple of years. 2 years ago, we implemented what's called Culture Index, which is basically like a psychographic evaluation tool. I mean, there's many of them out there, but I'm really a big believer in Culture Index, which is basically a survey that you can have prospective employees take. And it's going to break down all of their natural innate tendencies that are pretty much encrypted into them since they were 12 years old. Okay, by the time you're 12 years old, the data shows that these are your tendencies. And it talks about autonomy, social ability, how fast paced are you? Are you slow or are you fast? Are you detail oriented or are you more macro? And there's 19 different profiles. And this really helps you to identify, if I have a role, what type of person do I want in that role? Because we got to the point where we're just turning through people, because we're not the type of people to keep somebody if we know they're not good. Like, we will cut them very quickly. You know what I mean? I don't want to say we're ruthless, but we're kind of ruthless. You know what I mean? Because we've just gotten to the point where we don't have time for people that aren't getting results. And if you don't fit our culture, you're definitely gone. If you fit the culture, you're the right person, maybe you're the wrong seat. We'll try to, put you in a different seat to help succeed and get the results. But I also tell our staff, we do like a quarterly all staff meeting. We speak to all the employees, and I tell them that this is not a bureaucratic structure. Okay, we are here to win, plain and simple. And you don't have to be here for a year or 2 years to do an annual review and get a promotion. If you are bringing value and working hard and helping us win, we'll give you a raise in 3 months, 6 months. And we do it all the time. We promote people. And so I'll get to our core values here shortly, but Culture Index has been critical, Jeremy, for hiring people, because what it does, it's not perfect science, nothing is, but it eliminates a lot of different people that you would otherwise waste time interviewing and maybe hire the wrong person. It's been very successful for us. And then also, it's a good evaluation tool to evaluate your current team members and make sure, do you have the right people in the right seats? And some of these people, we look at their surveys, and these people have been with us for 2 or 3 years, and we look at their survey after we started using this, we're like, wow, that makes total sense. We need to either move they're not very effective. Let's move them into this other department in this different role, or let's just get rid of them. You know what I mean?
Yeah.
Because we're not doing each other any justice here. The second thing, really quick, I want to talk about is next level growth. Okay, so everybody's heard of like EOS, Entrepreneur Operating System. So next level growth is a version of that. But basically, it's a blueprint that you use with tactical meetings, and we established our core values. Okay, and these core values are what we established this just over a year ago to evaluate any new prospective hires and people who are currently in the company. And so we have an executive leadership team of 6 of us, and we created those core values ourselves. And we wrote down like the top 10 people in the company. Like, who are the best people? And then what are the traits that these people exhibit? And then based on those traits, let's create core values. And so now we have these 5 core values, and that's kind of how we judge people and evaluate them.
Yeah, that makes total sense. And it was funny because Kevin, somebody who I know, commented and said he loves the culture index, and he is an architect. Kevin, I am also an architect, and
Nice.
this is not a culture index commercial by any stretch of the imagination, but I had my 4 children take the culture index, and it's really an interesting thing for me to be able to learn about their temperaments, kind of what they're good at, what they enjoy, what they don't enjoy. And it really actually honestly helps me to be a better parent to them as well. So I could only imagine how it could definitely transform the workplace environment as well.
Oh yeah, I know people that are literally having people that they're dating take it, anybody that they want to take on as a vendor, because it's like, I don't want to work with certain types of people. You know what I mean? Is the philosophy there. So it is pretty powerful.
Yeah, that's great. Well, I'd like to maybe kind of pivot a little bit and talk a little bit more about kind of, where we're at in the multifamily market cycle right now. I've heard a lot of people in the space say survive till 25, survive, the multifamily, market meltdown. But within Rise 48, outside of the things that you've commented on already, what are some of the things that Rise 48 is doing internally, really to kind of, further attack the market as it relates to our existing asset classes? I know we've talked about kind of this operational, value add, type of a strategy where we can get creative on forcing, NOI growth rather than just waiting for the market to recover. So maybe you can kind of talk a little bit more about, what Rise is doing right now to, further sustain, the assets that are already in our existing portfolio.
Yeah, it's a great question, Jeremy. And we've had to really pivot our strategy. And I want to give some quick context about the impacts of supply and demand, which has led us to do this. And this has really been impacting the whole market. So to give context to people, from like 2018 to 2022, you had all these people that are leaving these progressive markets, especially post-COVID. They're leaving Washington State, they're leaving New York, New Jersey, and they're going to the Sunbelt. They're going to Arizona, Vegas, Texas, the Carolinas, and that creates a huge need for housing, right? Because there's all these new people moving here. So these developers start building apartments like crazy in these Sun Belt markets. And it takes about 3 years for these developments to get what's called delivered, meaning that they're built, they can be lived in, all the entitlements and zoning is done. And so what happened was really, especially 24, 25, and 26 across the Sun Belt throughout the country, we've just been getting hammered with new supply of housing. Okay, new apartments coming online. Well, many of you remember interest rate. This is completely independent, by the way, from interest rates. In 22, 23, 24, interest rates were like the big headwind, and they still continue to be. In our opinion, the supply is the bigger challenge right now and has been the last 18 months or so at least than interest rates. Okay. And so basically you have all these people that are, moving to these markets. They're building new apartments to accommodate this. Well, people remember 23, 24, inflation gets to like 8 or 9%. And it has come down. But some people don't realize, Jeremy, don't think about it, is that if it went up 8% and then it comes down to 3%, that's still 11%. It's not like it went down. You know what I mean? It just the trajectory came down. And so what's happened is that for the economics to work, for people to build these new Class A luxury apartments because it was so expensive to build, you had to command very high premium rents for those projects to make sense economically. So you can only build Class A luxury apartments if you're building apartments. Those rents are at least $3,000 to $5,000. There's a very small percentage of the demographic that can afford those rents. A lot of those people are trying to determine, do I rent this apartment or go buy a house, right? Well, with all that inflation that happened, people's grocery costs, their cost of living, their gas all goes up significantly. And so now you have these new apartments with these extremely high rents are being delivered. They need to be leased up. the demand has significantly decreased. So you have more supply than demand. So economics 101. And these apartments are literally giving 2 to 3 months free rent in order to try to lease these things up. I mean, it is standard right now in Phoenix and Dallas, 3 months free for Class A luxury apartments. Well, we've always focused on Class B housing, affordable workforce housing. Our average rent right now across 11,000 units is between $1,200 to $1,300 a unit, right? So it's the more affordable option. It caters to the bigger bulk of the demographic. But there's still a trickle down effect where a lot of our properties have had to give a month free. Okay, so these concessions, or what those are called, are biting into net operating income, right? And you've had organic rent growth, was at least 2 to 3% positive for over a decade in places like Phoenix, Dallas, every year for a decade, has been negative now. The last 2 to 3 years, you have negative organic rent growth. Okay, and so what's happened is that with all this supply, it doesn't make sense to spend thousands of dollars to renovate units in order to push the rents up because the rental premiums are not there, right? And so that doesn't mean we don't want to just not buy value add deals because in our opinion, we think that we are at the bottom of the market right now. And we think we probably have a 12-month window here before that changes. The reason for that, and then I'll get to how we kind of pivoted our strategy. The reason for that is that the data is showing that the bulk of the new supply in the Sunbelt markets should get fully absorbed by the end of 26, early 27. Once this supply gets, because the good thing about, the Sunbelt markets, we're in Phoenix, Dallas, and North Carolina, Charlotte, Raleigh, Chapel Hill. The good thing about these markets is that people have not slowed down moving to these markets. These are top 5 markets in the country for new population growth, new job growth. So people are still moving there. The demand is there. These apartments will get absorbed because at the same time, since the second half of 2022, when interest rates skyrocketed, it blew up all these construction loans. There's been little to no new building or development of apartments since the second half of 2022. And remember, it takes 3 years for these things to get delivered. So there's a residual effect here where now, starting in 27 for the next few years, we actually have a significant shortage of housing, of apartments for all the people coming to these Sun Belt markets, Phoenix, Dallas, North Carolina, Florida. There's a significant shortage of housing, which will burn off concessions, meaning that those concessions will be eliminated, which will significantly increase net operating income. And then you'll also have positive organic rent growth come back. So you'll have tailwinds. Well, so right now you're buying these deals. We can buy these deals that are, distressed at literally 30 to 50% discounted basis from the peak of pricing in 21, 22. And we should have tailwinds the next 3 to 5 years. What we've done, we started this last year, is that we're like, okay, you know what? In the short term, until this supply gets absorbed, it doesn't make sense to spend thousands of dollars to renovate these units because the ROI, the yield on cost, is not there. We focus on operational upside. Okay, so what does that mean? Well, we're doing things like bulk cable contracts. Okay, so for example, if I have a property, and this is an actual example from a real property right now that we're about to close on, the tenant is currently paying $113 a month for like an amenities package, right? Which is bulk cable, internet, et cetera. Well, they are having to go to the cable provider individually, okay, and pay, whatever that price is. And the property currently is making $13 of the $113. Well, what we do is we go to the cable companies and we negotiate a bulk cable contract where we say, okay, XYZ cable company, we're going to have an exclusive at our 200 unit property. We're going to make all the tenants use you. You're the biggest game in town anyways. Everybody's probably using you anyways. There's going to be 1 or 2 other competitors. We're going to make everybody use you. And you're also going to include additional streaming options for them. So they're going to get Paramount, they're going to get Hulu, Disney Plus. So they're going to be able to bundle all these different streaming things as part of this new package. The tenant is going to pay the exact same price. They're going to still pay $113 for all this. But now I'm going to give you all these tenants. You're going to have 200 clients guaranteed, but we're going to have a profit share there. Now I'm going to make 65 bucks of the 113 instead of $13. So I haven't had to increase the rent or the cost of the tenant at all, but I've significantly increased the net operating income at the property level, which increases the value of the asset, right? So I didn't have to spend any money. I have no CapEx expenditure. So it's basically infinite ROI because I have no money that I had to lay out, right? So these are types of things that we're doing. In certain markets, if we can charge for carports, we'll build a carport and we'll charge for the carport. On assets where we can do valet trash, we're implementing valet trash because there's no cost to us whatsoever, right? And it's an amenity to the tenant, and we're getting that revenue share. Even on our operational value add deals, we're still budgeting like a light value add turn, maybe like $3,000 to $5,000 a unit to do new flooring and countertops. But some of these deals that we're buying right now, we're buying them at such a low basis that we don't even have to push rents that much. We could push rents 50 to $100 across all the units, and we're able to hit our projected returns because we're buying it at such a lower basis, such a higher cap rate. So in this environment where there's not a lot of rental premiums, this is the strategy that makes the most sense. This is how we've pivoted to. But there will come a time, whether it's 27, 28, we think it'll be next year, 27, where the supply gets absorbed, concessions will burn off, organic rent growth comes back, and there's going to be a shortage of housing, which means that we can renovate these units and get those premiums again, and we'll go back to that. So that's kind of how we've pivoted operationally.
Yeah, yeah, no, that's great, and I appreciate that kind of feedback there. And just so the listening audience knows, there are times during the market cycle when it does make sense to force NOI growth through a renovation strategy, and there's also times during the market cycle where it maybe makes more sense to pump the brakes or really take a step back to make sure that you're getting those rental premiums, from that tenant base. And this is really Rise's strategy, based on what Zach has kind of been explaining here. This is Rise's way of really manufacturing additional NOI growth without having to wait to a point in the market cycle where it makes sense to renovate interior units and force NOI growth through that value add strategy. So as we kind of look to wrap up here, Zach, there's one other thing that's kind of been on my mind and would love to hear, maybe more about your kind of feedback. We hear a lot about, artificial intelligence and AI, and, some people in certain industries or sectors are maybe a little bit nervous about their jobs and kind of what the future is, in terms of the AI, revolution, that we're really on the doorsteps on, from what I can tell anyways. How do you see AI having the biggest impact, in the multifamily space, in the next maybe 3 to 5 years, and how is Rise staying on the forefront of the AI movement?
Yeah, no, it's a great question. Everybody's favorite buzzword is AI, and I think a lot of people at this point kind of roll their eyes. And I'll give some context here so that people know where I'm coming from, just to be 100% transparent. So I am Christian, and I am religiously, fiscally, and ideologically conservative, right? That's where I kind of come from. So the last few years, or a few years ago, I was actually very anti-AI. You know what I mean? Like a lot of the headlines you see, like, oh, like I don't trust AI. This is not good. And I was also skeptical because everybody says AI this, AI that. In the last few years, I'm like, this is bullshit. Like, what are we actually using? What are the use cases for AI? Like, what is it actually doing besides a chat bot? My mindset is completely shifted, and I'll tell you why. So last year, I read a book called The AI Driven Leader, which I recommend everybody read a book, AI Driven Leader. You get it on Audible. I do everything on Audible while I work out. It's not like a technical book. It's very simple. It just talks about how you can kind of use AI. And it kind of gave the examples how with every new technological breakthrough or innovation, there is always mass panic. It even went back to like when the typewriter was created, the Catholic Church was so against it because people could put out negative information about religion. The internet, people were so against it because of all the potential for fraud and et cetera, et cetera. So what I've had to realize and what I recommend people do, I mean, you can do it or you not do it, but we're doing this at Rise 48. AI is coming whether you like it or not, and it is changing very quickly. And our philosophy is we want to embrace it and we want to be on the front end of it. The biggest breakthrough, some people may have heard of this, is Claude Code. Okay. It just really emerged end of January, early, it's like literally 6 weeks ago, 6, 7 weeks ago, early February. Those of you who aren't familiar, you've probably heard of OpenAI. They own ChatGPT. Anthropic owns Claude. So Claude Chat is like their version of ChatGPT. And then they have what's called Claude Code. Claude Code can basically build out code. Like it can build websites, applications, like apps in like a matter of hours, and it's crazy. So we have created at Rise 48 what we call an AI committee. It's Bikram and myself, and there's 4 employees who are very passionate about this. And for the last few weeks, we have had a daily stand-up meeting every morning at 9 a.m. And then we have two 90-minute meetings throughout the week because we are basically focused on how can we optimize everything possible. And I know the big concern with AI is that, everybody's going to get laid off. That's not how we look at it. Okay. We look at it as if there are clerical or administrative tasks that a team member or employee is doing, that is now a complete waste of their time. They need to use AI to replace those jobs, replace those things so that they can elevate the tasks that they are doing. Okay, I met with our marketing team a couple weeks ago. I had them watch this 30-minute. I've been watching YouTube videos on this like crazy the last few weeks, like in the morning and when I'm working out and stuff like that. And I told them, watch this video, and I want you to shift your mindset from being a doer and an executor to using the AI to execute and run automation so that you can be more creative and focus on strategy. Okay. I mean, I heard a statistic the other day. I think it said, I don't want to get this wrong. It was very significant. I think it said like 40% of all jobs in the United States right now did not exist 70 years ago. So like when the Industrial Revolution started, I just read the John D. Rockefeller biography. It's like when you have innovation in transportation, technology, manufacturing, whatever, it literally will create new jobs. So one thing we got to focus on as an economy and as a country is, okay, how can we elevate the tasks that we are doing? Because this is going to eliminate a lot of jobs. I think that knowledge-based workers like, attorneys, accountants, engineers, they're going to become obsolete because this is crazy. Like I'm telling you, I'll give it a quick context. In 2021, we engaged these software engineers in Ukraine. This was pre-Russia-Ukraine war, and our engineers they're still good. They're alive and well. And we have invested $2.5 million of our own personal cash the last 5 years into building out our own investor portal. It's called Fundamental Portal because we did all these demos with Juniper Square and all the other ones. We didn't like their user interface or their workflows. So we're like, let's screw it. Let's just create our own. So we created this full-fledged portal. And it's a nice portal. It's a good portal with software engineers. And we have third parties. We've been trying to build it with third parties. We have over 100 third-party clients. The goal was eventually build it up and sell it. Well, there's a functionality where we're doing distributions. Our assistant controller, Jerry, he spends 2 weeks of his month the last few years doing distributions. We do 4,000 distributions every month, and he wants to always make sure they're done correctly. 2 weeks of his lifetime, okay, or of his life, the last 3 years. And we went to our software engineers in Ukraine and we said, hey, we want to automate this. They said, okay, you're going to have to give us 100K. It'll take at least 6 months and it'll probably be more than that. That's just for us to get started. In 2 days, this was 3 weeks ago, in 2 days with Claude Code, he automated all the distributions and it's all encrypted and completely secure for a $200 monthly subscription. So we saved 6 months. We saved at least $100,000. And we realized our investor portal is worthless now. It's not worth anything. And SaaS, I'm telling you, if those of you have been paying attention, in the beginning of February, SaaS companies' stock started to tank. SaaS is going to be dead. They're going to have to completely shift their model. I'll give you one more example. We use HubSpot as our CRM for marketing, things like that. We probably have at least 50 employees with HubSpot subscriptions, right? That's the SaaS model. Software as a service is what SaaS stands for. It's all based on recurring revenue through user subscriptions. I've got 50 employees at least that have these subscriptions that we have to pay each subscription, each user for HubSpot. Well, now this is what we're doing right now. We're working on this right now. We can basically just create bots, and I can have 50 bots that do all the tasks that my human users needed to do. And I only need one user subscription to manage the bots. So HubSpot's going to go from having 50 subscriptions to one subscription. I mean, Salesforce, their stock was tanking in February. This is going to completely change the game. And so we are optimizing AI and taking advantage of it to automate and just make more efficient everything that we do. From accounting, we're creating our own HCM right now, which is basically human capital management. Like you used to work at ADP, the biggest, payroll system in the world. We're going to still have an API to an HCM to help with our liability for payroll. But other than that, we're building out all the functionality in there. And it's going to have everything that we need from our core values to all that stuff. So we are literally going to every single department and we are optimizing right now and building out our own proprietary Rise48 operating system because it does all the coding for you. It's crazy. And so anyways, I was very skeptical. I thought this was all BS, the whole AI thing. Like, what is it actually going to do? In the last 6 weeks, we have seen this is the actual application and it's a game changer. And so I think regardless of what business you're in, just start to learn about this stuff. Just start watching videos because it can optimize a lot of things.
Yeah, it's really remarkable as to where things are headed, and it's really, comforting to know that Rise is on the forefront, of that movement and really embracing, kind of that transformational change, that AI is really, creating, across the landscape. As we kind of look to wrap up here, Zach, and this is a question that I could very easily, answer myself, I'm sure, but I want to ask you a question about Stump the Sponsor. Okay, you ready? This is
All
the
right.
Stump the Sponsor. All right, question
Sure.
you never heard from me before. So I know there's a really, kind of famous movie out there by Tom Cruise, a recent movie, a blockbuster, I think, a couple of years ago. And I know that you have a son that bears that same name. So is there any correlation or direct connection to Tom Cruise's latest, Top Gun hit and your son's first name?
No, it's a good question. Yeah. So our firstborn, we named him Maverick, Mav for short. And I get that question all the time. And honestly, we did not think of that. It was not a connection to the Top Gun movie, but it is a good movie. I've seen it a couple times. We just thought it sounded cool and wanted to be unique and kind of make him like a rebel. And so that's why we named him that. But yeah, it's a good
Yeah.
question.
Sounds good. Great name and a great movie as well. So,
Yeah.
with that said, I'd love to just have you let our listening audience know a little bit more about, where can they connect with Rise 48 if they want to learn more about what the company's up to.
Yeah, yeah. Thanks so much, everybody, for listening. Really appreciate it. Thanks, Jeremy, for having me on. You can go to our website, Rise48 Equity, RISE48equity.com. You can set up a call with our team if you want to learn more about what we're doing. And yeah, we'd love to talk to anybody and let me know if I can help with anything anybody's doing.
Yeah, sounds good, Zach. And listening audience, thank you again for jumping into yet another episode of the Live on the Rise podcast. We look forward to having you join us on the next episode.
Thanks, everybody.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.